Alrighty, hello everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating the session tonight with Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I'll introduce Rob. Alrighty, so first and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you would like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. All right, well, it's really all about the Fed tomorrow. There's not really much left to say on that. So always eager to hear Rob's thoughts each week, and especially this week with everything that's gone on so far. And very excited to interact with you all. So thank you for joining us for this live session. And at this moment in time, I'll introduce the man of the hour, who we're all here for, and that's Rob Roy. Rob, how are you this evening? Feeling a bit quiet, apparently.
Just for some reason, the bar wasn't showing up at the bottom. Now I've got all the controls. So hopefully everybody can hear me. How you doing tonight, Zach?
Doing well, sir. Happy to be back with you.
As everyone will be able to see here momentarily, I am back in the Dragon capsule. It feels good to be out of the mountain pollen. That was a lot of fun, but had some fresh rains down here in the Sunshine State and kind of washed the pollen away here. So the sinuses are good. Going to put in a throat lozenge just in case though, so hopefully no coughing or hacking. And looking forward to tonight's session. So we had a bit of a downward move today, and gosh, it's been a lot. Last week we talked about taking the optimism off the cautious optimism. Still no five-wave qualified pattern. We look at the moving averages, and you can see that we closed just below the 10-day moving average, came back and tested the 50-day moving average here back on the 26th of April, and then rebounded. So we had gotten below 410 and had a follow-through day there. So the last bastion of support was the 50-day moving average before we were looking at coming back down to 390, and it held. So we moved back to the upside. Well, we reversed today, but I don't know that today matters. looking in front of the Fed, as you mentioned, Zach, tomorrow going to be one of the more heavily watched Fed meetings in a while, I think. Did they say anything? Is it 25 bips and they're done? Or are they going to leave open the possibility of more? It could be a wild intraday trading session tomorrow, I think, with however the comments are viewed and whatever the actual action is, Powell's press conference, all those things are going to be scrutinized. So perhaps maybe not so crazy in the first part of the day and really crazy in the second part of the day. The positive here is that we still closed above 410. So the things that we were looking at before was that when we broke below the 10-day moving average and broke below 410, did we get the follow through day, which we did, but we also said, you know, the 50-day moving average is the trending average. Could it hold? Which it did, at least for now. Tomorrow may be the answer. Do we march up towards 420? Do we have yet another qualified zigzag here for potential move to the upside? And that gets us to 425. And if we go back and look at the big original zigzag, you can see that, look, boom, two different levels right there at 61.8. And as you know, there's another one in there. I'm not going to spend all night drawing zigzags, but possibly if the market likes what the Fed does tomorrow and has to say, we are marching up towards 425, but we got to get there first. And even though we did break back below 410 today, or back close to 410, traded below it, closed above it, he tried to say. I don't know that today really means anything in front of such an important meeting tomorrow. I think tomorrow is going to tell us a lot. And if we look at volume, you can see that very low volume session yesterday on this reversal day that we had. And then today, above average volume. I would imagine there was a lot of position squaring occurring today with in front of the Fed meeting. So I think that's probably what was going on. People don't want to be caught off sides, but as they go back and draw that line, there's that big line at 410. So that's the key. Looking at interest rates, we'll look at the TNX down day today in rates. And it looked like back when we closed down through did the test of the 50-day moving average, we gapped down on rates, but we gapped just down to 34 and we didn't break that level. So I didn't like the gap down. That was concerning. For those of you that may be new joining us, welcome for all the different social media platforms. But people have heard me talk about this a lot. If you're newer, probably haven't heard it, but 34 I think is the key important level for rates. I think the sweet spot is somewhere in here between 34 and 40. So if we stay in that trading range, I think that's good for the market. That's positive for equities to move higher. A little bit of a break of 34. If it's a slow move, a la this projection on the 45-degree angle here, I think the market could handle that. What I don't think the market would do well with is a big vertical move down in rates, because that means money's pouring into the bond market. As you know, prices and yields move in opposite direction. And to get vertical moves, it's more than just, you know, people balancing portfolios, some foreign money coming in, et cetera. When you get vertical moves, that means money's leaving the equities market and moving into the bond market, and that would be troublesome from the equity standpoint. So we're still in the sweet spot there. We're still in a qualified 5-wave pattern. Again, a break of 34. If it's a mild one and a slow, steady move lower, I think the market's okay there. It's a big vertical move. That probably means we're having problems in the equities market. Looking at the dollar, just does not want to give up the 101 level here. It's interesting that that's holding so strongly. I mean, it was support back in January, but really isn't any magic to this level here. And as you can see, we just broke it enough to label the wave 5, but there is a projection for potentially going lower. But if we hang in there a little bit longer, then what'll happen is the algorithm will take this projection off and we'll say, hey, that 5 is in. And then we could look for a potential for the dollar to start to move back up towards that previous 4, which is what should happen. Anytime you get a wave 5, for those of you that may be newer to Elliott Wave, that doesn't extend beyond 100%, it retraces back to the previous 5 when the wave, or previous 4, excuse me, when the wave 5 is finished. If you have a wave 5 that extends more than 100%, it only retraces to the 61.8% fib level. So we're getting in that area. Wouldn't take too much more to see some support come into the dollar. That 5 label as being complete, the projection go away, and then monitoring the march back up to the wave 4. So it's going to be interesting to see. Let's look at some of the other markets as we take a look. And looking at the DIA, we can see that that 340 level proved troublesome to the DIA. It had broken below it. Still no 5-wave pattern here either. And then got back above it, but couldn't hold it. Again, it's just tough to put too much into what happened today. Obviously, we can put a little bit of thought into what happened the past couple of weeks, but today's move in front of what could change the markets dramatically tomorrow, I think is just talking points right now. The main thing, we came down, tested this 50-day moving average as well, and we pretty much tested it today also on the DIA. The DIA was down over 600 points at one time today. How are the Qs doing? With rates hanging in there, that'll be interesting to see. And if we look at the chart there, we know that that 320 level is key. And there we are right there at the 320 level. We did make it into the tap box. So we've broken above that level. Labeled the wave 5 here. Again, the 5 has moved. It was over here, and now it's relabeled here, telling you that we had a new high yesterday. And so at any point in time, it could be the end of this wave 5, unless it's going to go through an extended wave 5, which could happen. Again, we'll see how the market reacts tomorrow. If the Fed says, hey, 25 and we're done, perhaps that gives a little bit of a bid to the Qs as it starts looking towards the expected rate cut at some point in time in the future. The talking heads on the media outlets are all over the place. Some are saying there's not going to be any rate cut for a while. Others are saying depends on how deep the recession gets. And then still others are like, yeah, I think we're probably cutting rates before too much longer. I'm in the camp of not too distant future if we start to see the recessionary pressures stronger than they are. The GDP is going down, inflation's coming down a bit, although it's stubbornly high on the PCE, which is what the Fed looks at. But the Fed seems to be getting their way. They're certainly having an effect on the financials, the poor regional banks. Rough day for them today as well. And, I feel for them because they got caught off sides. Some of them obviously have been doing some things they shouldn't have been doing, and they literally let them go out of business. And then they opened up that facility, the lending facility for others to use. And I think that's kind of a we're sorry type of thing to try to keep some of these other regional banks afloat. Boy, if you get a bank failure now with that, then they were probably taking on too much risk as well. But you're just going back your normal course of business and where rates have been and all the things that have been the norm. And then the Fed starts raising rates so dramatically, so fast, it's just not enough time to react, and it puts you off sides. So I feel for those running financial institutions that are trying to do everything the right way and still got caught like that. Looking at the Russell, there we are, 170. You know the story here. We're back down to 170. Are we going to hold there? If not, then we're probably looking at creating some sort of a new range. How far down do we go? 170 will then become resistance, but we tapped it on the low, tapped the 10-day moving average on the high. So the Russell just hanging right there at 170, but it's precarious. It held back here in March, but now we're right back down testing this level again. And we'll have to see. So notice that we're lower on the IWM than we were at the end of last week when we were getting that sell off to the downside and below 410 on the S&P. So that doesn't incite a lot of confidence from a risk on standpoint. So we'll look and see how that continues to play out. Speaking of risk on, look at Bitcoin holding in there amazingly well. Update today for Bitcoin. We talked about this. We had this really well-formed triangle, vertical breakout. It seemed that 2 vertical moves was just too much. And so we retraced this one, and we also retraced back to the point of the breakout pretty classic corrective Elliott Wave corrective triangle action here. So come back to the point of the triangle and let's see what happens from here. Do we hold here and continue back to the upside? You know, it just feels like every time there's negative news about the banks, Bitcoin does well. So is that just a concern about our banking system? And so money is running to digital sources? Could be. I'm still impressed that with this move down, it held right here at the point of the triangle, and we didn't retrace any of this vertical move, at least not yet. We haven't. And the longer we go, the less chance there is that that's going to occur. Let's take a look at a few of the international markets. We'll look at the EWA. So we take a quick look here at the EWA. We only look at that one on Tuesday nights. On Thursday night for our alert subscribers, we have some that like the XJO. We look at that one on Thursday night, and you can see here we are right back down to this 23 level, which is really crucial for our friends down under. We need to hold there, and again, very precarious sitting right there. And if we can't hold it, you know, the old analogy that I've used numerous times, fingernails holding on the edge of a cliff, is exactly what it looks like. If we don't hold 23, we're likely coming down to 22. That's the next area of support. And then if it breaks that, it could be, who knows, possibly all the way down to 20, but that's a ways away. We don't have to worry about that right now. The key is, can we hold 23? Can we get back above 23? Or are we going to fall back down and test this 22 level for Canada? So looking at the EWC, below 35, as you can see, which was a key level that had acted as resistance. Look how many times: August, November, January, February, and April, and kind of moved back up there. A little bit of a pattern of gradual, but a pattern of lower highs here, working on the EWC, traded below the 50-day moving average, closed above it, but below the 10-day moving average. So you can see it's pretty precarious depending on what the Fed does actually come out and say tomorrow and what they do. Things could change dramatically, but for now, it could get really ugly really fast if whatever the Fed does and says doesn't satisfy the market. The Indian market, probably, as we said last week, one of the strongest international markets out there. And look how they completed this zigzag pattern here. And we just draw it right here. As you know, I'm a big zigzag fan. Look at that. You want to know why I like to look at zigzags, why I believe in Elliott Wave and Fibonacci ratios? Look where we went. You have a 38, almost 38.2 spot on B wave correction. That means you're supposed to extend 61.8. Where did it go? 61.8. Again, spot on, exactly what it's supposed to do within Elliott Wave and Fibonacci patterns. Now we find out what's going to happen with the INDA, because we're still in a 5-wave qualified pattern to the downside, and the wave 4 is at, in my opinion, the strongest of all levels, 61.8. So we're a little bit overbought now, a little bit above the 10-day moving average. We got there yesterday with this vertical move. So do we head back down on the INDA, and does all that goodwill of that zigzag get retraced and we move down to make a new wave 5? It could. If we can break much higher than this, it will disqualify this 5-wave to the downside pattern, and we're all clear and likely running back up to these highs that occurred back in November and December. But again, we're a ways from that. The 61.8% level will probably act as some resistance. It's, as I said, the strongest, in my opinion, of all Fib levels. So looking at Germany with the EWG, and still hanging in there pretty well too. And you know, you could argue, say, well, you said India is one of the best international markets. How can you say that's above the EWG? Well, this long move to the upside since October, yeah, you make an argument that Germany's been the best, but India is not far behind, if any. And you know, there's been less rapid movement since early February on the EWG, although it has moved higher. Gap down below the 10-day moving average might be a little bit of concern there, but all this stuff could change after tomorrow's trade. So I think we just have to wait and see how all that plays out once we get to tomorrow. All right, so that covers the markets, the international markets. Let's look at some of our past case study considerations and looking at MPWR. This is an old one. I don't know if anybody's still following this one, but it was back mid-February where we looked at it, and you can see it's trying to come back to the upside there, labeling a wave 4. And when we talked about it, if you were still hanging in there, you needed it to hold this 440 level, which it did so far. But that's a pretty decent pattern of lower highs there, forming not the greatest, but a decent descending triangle. And I say not the greatest because it's not that big considering it's a $550 stock, and this stock moves so much intraday. But it's a qualified 5-wave to the upside pattern. And could we turn and move back to the upside here, or are we going to break down? As a reminder, when you see a descending triangle pattern, that does not mean, although there's a lot of marketing that exists out there that says a descending pattern breaks to the downside, and that doesn't occur any more than an ascending pattern breaks to the upside. Whether you have a descending, symmetrical, or ascending triangle, they all break either direction. That's what the data really shows. I know it's easy to market systems and say, hey, descending goes down, ascending goes up, but the data doesn't show that. They can go either way, and you have to keep that in mind. So although it's not the widest mouth of the triangle, it's well formed as a long but thin descending triangle, and we could have, you know, a bit of an explosive move. Note that all the moving averages have pretty much converged right to the point there. Right when it looked like we were breaking to the downside, it held it one more time. So I just wanted to show that and see if anybody was following that. Amazon, we had looked at that back here with a nice pattern, and we sent out an alert to our alert subscribers, and I'm going to show you what we did. So there's the breakout to the upside, and we were going into earnings. So the day before earnings, what we did was we went ahead and closed out the call side. So we closed out the call side because we had gotten some juice right in front of earnings, and we had broken nicely to the upside there and had gotten slightly in the money on the call. So closing that out guaranteed us a nice gain. So we were going to make 40% regardless, and just held the put as a lottery ticket, see what happens going into earnings. And really not much happened. Had we had a massive downward move, then the put could have regained some value. It only had 15 cents in it at the time. So we gave up 10 cents by holding it and closing it out for 5 cents. And we ended up with a 42% return on the triangle. So I just wanted to show you exactly what we had done for our alert subscribers. And if you were following this and put on a triangle, what did you do? And that's the difference between what we do at TradeFinder and our alert service. At TradeFinder, we find case study considerations and we say, hey, this looks good. And then you're on your own to create a strategy, create a trade, and manage it. With our alert service at EWOTrader.com, we send you out alerts on entries and exits and any adjustments in between. Similar to what I just showed you there, as far as giving up 10 cents as a shot to see, could we move to the downside? And you may say, well, if you do that, why go ahead and close it out at that point in time? Well, since it didn't make a big move to the downside and the strike is all the way down here at 80, the likelihood, even if Amazon comes back down, if the market does get weak and roll over, the likelihood now that it's going to move far enough after earnings with the IV gone to create any value in the put is so remote. It just, all right, let's just close that one out and move on. So that worked out well. So we're going to close the Amazon one off. Hopefully y'all did well on that one too. The next one that we look at was Adobe back on April 4th. And this was the pattern there, and it was going a bit sideways, and it still is. So the difference here is, note that we still had the tap box in play here, that projection. So this is what I told you, would happen if we don't move up far enough back on the is it the dollar pattern, where that 5 will go away. And this will just be labeled as the wave 5 being complete. Well, that's exactly what's going to happen with Adobe, or it's exactly what happened with Adobe. And so there gives you an idea of what I was talking about with the dollar. And so, it's kind of a no harm, no foul. It's just basically gone dead sideways. You could make a little case that, we're bleeding a little bit of time value. We've got some lower highs there. I think it's worth hanging in there and see what happens tomorrow. If the Fed is done, it could be good for all technology, and you may get a big burst. So even though it really hasn't done anything, 380 has been acting as stubbornly strong resistance. All that could change. If the market doesn't like what the Fed says tomorrow, then I think you close this one out, because a break of 360 likely means watch out to 320. That's probably the very next stop if we don't hold 360. So it might be worth just giving it one more chance. You can see it's still above the 50-day moving average, and see, maybe the Fed gives the market what it wants tomorrow and we have a big up day. So we had Google also on the 4th, and you can take a look now, and kind of a sideways thing here as well. So not much has changed. It was at 104 and it's at 105. So we moved up $1. So the movement may have offset the time decay. And I feel the same way about the Google position as I would Adobe at this point in time. I think it makes sense. We're well above the 50-day moving average here, 105 becoming an interesting point of support, which happens to be where that previous 4 was back in October. So let's see what happens there, because if it breaks 105, a little bit of support at 100, you've got that big round number. But the scary part is if it doesn't hold between 105 and 100, we're probably coming back down here to 90 again. That would be pretty rough on Google. So I think just keep a close eye on these. EMN is another strangle. We actually have this for our alert subscribers as well. And you can see that we had this big move higher here. And this is an interesting thing to talk about. You don't get sucked in. And these are the head fakes that occur when you put on strangles and then you get a break. So we had drifted down, then we have earnings, and it looks like it's a big break to the upside. And so you might be thinking, okay, look at that move higher, take the puts off, we're running to the upside. And this is why we hold both legs until we get to the point where one leg is going to at least make our position break even. In the case of Amazon, taking the calls off gave us a 40% locked in gain. But if we get a breakout and one of the options means that there's no more risk in the position, then you can take one leg off and see what happens. So this would be the opposite instance of what we did with Amazon. So had this continued to the upside and the calls gained enough value to where there was no risk in the trade, at that point, you could take the puts off and see if the calls were going to continue to run. So again, a different plan on that strangle versus what we did with Amazon. But this is why you don't jump the gun. Because that immediately reversed, and now it looks like there's a good possibility that we could be breaking to the downside, and that could be the big move on this. The put strike that we have is not that far away, so those puts could move in the money with any sort of weakness. And note where we are. We're at a level of support right here at 80, closed right on it. If we break below that, then we're probably coming down to 70, and if that occurs, we've got a great result out of that strangle. So it's all going to depend on how EMN handles this 80 level now that the earnings report has gone by. Boy, I sure hope you followed this one, ORLY. We've had this one on a few times, and it just never seems to disappoint. And you can look and see the fact that we were a bit overbought when we talked about that, and then bam, moving big time to the upside before tomorrow. I don't know that, it's not that overbought. Got a nice move to the upside here. 40 points move to the upside. How greedy do you want to be in front of the Fed? So I would say that if you get an upward move, rather than risking the Fed disappointing, go ahead and take that off, take your gain. Can always come back and put a new position on, as it does look like there's another, 30 to 40 points to go here to get into this wave 5. But I don't know that it's worth risking the gain already. So in my opinion, it would be take the gain. So we're going to close that one off as another winner and say, hey, we'll just we'll revisit this because we're still in a wave 3. And if we look at the DMI, you can also see that it's awfully high. So that's been a very strong move. You've got mixed signals here. The ADX is very high, so that's a little worrisome. It's good in the fact that this has been a strong move. It could drift higher from here, but with the ADX up there, about 45, is telling you the strongest part of the move is over. And again, just to repeat for those that may not be familiar with the DMI, the ADX moving up like this is telling you that was a very strong move, but it's so high, it's telling you the strongest part is now over. It doesn't mean the entire move is over. It can still go higher as it weakens. Stocks move up as they weaken all the time. So it doesn't mean the entire move is over. That occurs when the ADX breaks back down below 40. So if this black line were to curl over and drop below 40, that's when it says, okay, now the move is over, and you would want to take your gains. Here, it's just, all right, if you want to hang in there, be really careful, because it could roll over at any point in time. Now, if we look at the zigzag pattern, and this one doesn't really count in my opinion, because it was a 24% wave 4, B wave correction. In reading Elliott's writings, he didn't like the 24%. It's a fib level. 23.6 is a fib level. He didn't like that as far as a correction. He didn't feel like that corrected enough. He looked at that more as this is one big impulse, even though you can clearly see this drop down. But because it only went to the 24% fib level, he would say that looks like more just a momentary blip. And this has been one big impulse move, which means the next corrective move could be even bigger. So another reason why you might want to just go ahead and take that gain. And then I know there was some concern last week when we looked at Merck because of the earnings report that was coming out. I made the comment last week, and I've seen enough Elliott Wave patterns that the earnings don't concern me that much. But we did say that if we don't hold 115, then perhaps you want to get out. Well, the next day we opened there, traded a little bit lower, and then on the earnings report, closed back above 115. But if we followed the guidelines here on what we had said, then you would have been out. It opened right here. So if you got in, or if you just watched it and waited, pretty interesting one there. We were kind of spot on with how important the 115 level was. You can see how it went sideways there. But all this intraday stuff that happened the next couple of days would have been a difficult entry. But, had you been really coy and watched this move down to 110 and saw it bounce from the 50-day moving average, then you would have made a nice trade. It's not fair to count that because we didn't say that. We said that if it held 115 after earnings the next day, then go ahead and put it on. It technically didn't hold. It did come back the following day, but it didn't hold the next day. So it was a little bit nervous before the earnings report. So perhaps that one was never entered. And at this point in time, you see it tested that 50-day moving average. It tested that very strong support level at 110. It is in a sector that we talked about as far as being a bit defensive if the market does roll over. You can see the positive directional indicator has regained leadership. So it's telling you the buyers are in control of this right now. Breaking above 115 is super interesting. But I don't like the fact that the ADX, because we've had 3 straight days where we've gone to the upside. Now, in this indicator, the 2 directional indicators are very responsive, immediate, daily responsive. The ADX is not. The ADX lags. Takes a little more time for it to turn. But with 3 days to the upside, if we're really liking this, there should have been at least some sort of a curl back up to the upside here on the ADX. So that makes me nervous. So I think all in all, likely never got in this one. And at this point in time, breaking above 115 is really interesting. It's interesting to see that the buyers are in control, but the target's not that far ahead. And so I think we just write this one off as a no-go. It didn't do what we said to stay in, but it did show you that a couple days of volatility that the Elliott Wave pattern held. It stayed in the wave 3, and that's why I don't get scared off of earnings reports if you have a really good qualified pattern. But we need to honor what we said, and that's what we said last week was watch the 115 level, and So I think we just call that a no-go. I mean, I have it right there in my notes. Has to stay above 115, and it didn't the next day. So it would have been no entry. And then anyway, that's that one. All right, so I wanted to show you another one of the alerts that we had sent out to our alert subscribers. This one's an interesting one. This one was in our time strategy. That's our AI-based strategy. And gosh, has AI not been the talk of all the earnings reports that have come out? Seems like everybody's talking about AI now. And I really feel like we're one of the first ones to market that had an AI-based technical strategy. So this is our time strategy. We look for stocks that have had a big move down, and then the AI examines over 300 data points and gives us a score on the likelihood that the stock will stay in a trading range. So once it does that, then we put on a butterfly, a calendar, some sort of a sideways strategy to where you're taking advantage of time ticking away as it stays in the trading range. So it's not making a big directional move. Well, some of the things that have happened recently, there's been some that have continued to move down in the squirrely market, and there's been some assignment issues, which creates all kinds of anxiety within people, especially we're adding new subscribers all the time. And so when an assignment occurs, never fails that we get questions on Thursday night, or we get comments writing in. You can send in emails to me anytime through our support level. So subscribers will do that, and they remind us on, what occurs with assignment. And I wanted to show you this because I think this is really cool. This is a slide I used to show way back when we did a lot of live events. And when we would talk about assignment, it would remain calm, all's well. It's scary. And the messages that the broker sends out are scary. But all in all, assignment is a neutral event and can be viewed as a positive thing. And so that's exactly what happened in this alert. So we come back and we can see that we ended up with a 182% gain here on this position, $730 profit, and the stock got assigned. But what we did was we held the long put because you have a long put and a short put. The short put got assigned, sold the shares, get rid of those immediately unless you have a big account, but usually you just get rid of them immediately. And then we held the long put, and that's what all these comments are. And this is where I'm talking about how we send you out alerts on any entries, adjustments, or exits, and we tell you what's going on with these adjustments. So you can see there were comments along with the adjustments on what was occurring if you got assigned. So that's the advantage of having the alert service, is the added commentary and comfort, I guess, of people that have been doing this for a very long time, telling you it's nothing to worry about. Now, we also talked about the fact that if you get assigned, it's likely because the stock didn't stay in the range. It may have dropped a little bit more. And if it broke that range, which we would have to have had a pretty good AI score to put the position on in the first place, well, it's likely going to be some follow through. So it makes sense, but we don't want to be a directional. We don't want this to be a directional position. That's not the idea. So it held it a day, stock went lower. You got an in the money put that went lower with 10 contracts, and all of a sudden, yikes, you end up with a really nicely profitable trade. All right, so that all sounds great, right? Look at that return, an amazing return, 23 days, which is right at the average for these time strategies. That was awesome. All right, so I always like to pat ourselves on the back when we time one right. Well, let's take a look at what happened with SMTC after that, because we had already taken it off, remember, and then taken that really nice gain, which I don't think anyone would complain about, 182% gain. And just as a reminder, assignment's not scary. It actually was a wonderful thing in this case, and often it is. But look what's happened with the stock. And now you could say, gosh, you made 182% and it still continued to go lower. Well, Monday morning quarterbacking, second guessing, whatever, never going to second guess 182% gain. But when you look at that, you're like, if you were still holding that long put, I haven't calculated it because I don't want to know what the profit would have been and how much that long put would be worth now. But holy cow, I mean, it's continued lower. And with 10 contracts of a fully in the money put, that's a really nice chunk added to it. But again, if you do that, if you second guess yourself, question yourself, beat yourself up, you'll go nuts trading. You can't do that. You have to make the best decision you can with the information you have at that moment. And that's what you do. And you don't second guess yourself, right or wrong, learn from it and, try to apply what you learned to the next one, but don't beat yourself up. So, it's, you can come back and say, gosh, if you'd only held that a little bit longer, imagine how much money we would have made in that trade. But still, 182% over $700 with the amount of risk that was in there, less than $500 is an amazing result. So I did want to share that with you and say sometimes, you think you've hit a home run and then you go back and look, well, gosh, it could have been a grand slam. Don't do that to yourself. I learned that a long time ago. It'll give you an ulcer if you get that worried about different positions. So let's see if we can find a case study consideration for tonight. It's kind of tough looking at this, so I'm going to show you something different. There's no AI trades. We have one impulse. Let's see what in the world that is. Texas Roadhouse. We actually have one near here. It's one of my favorite places to eat. They've got a great grilled chicken salad. It's freaking awesome. So that's this seems to show up a lot. I've talked about how Google's number one for me with the number of trades put on over the years and within Elliott Wave. For whatever reason, it just tends to show Elliott Wave patterns a lot. Well, here's Texas Roadhouse, and is it in a 5-wave pattern? It is. Man, the wave 5 has already extended 114%. Now you expect, and we've been talking about these in the live updates that we do on Friday, et cetera. Coca-Cola, McDonald's, we've been featuring those in the past few live updates. But Texas Roadhouse, it's not in the same realm. So if you're thinking of, the consumer tightening their belt, and one of the things that was in the last consumer confidence report was they're not going to go on vacation. They're going to be staycations this year. So you think that inflation has affected the consumer. Perhaps they're not going to spend as much. This one's a difficult one because it's a restaurant. And so you would think, okay, it's a pretty defensive sector. It's a good place to hide, but it's not what you would think as far as, more of the bargain stuff. You're looking at the Walmarts and the Costcos and things like that. The McDonald's, a fast food place, Chipotle, which blew earnings out. Those are places that I think make sense. This one I have a little more trouble with, especially when the wave 5's already extended 114%. But with all that said, look at the DMI, which is about to set up again. So this is the final straw on why I wouldn't do this. I've given you some fundamental stuff. The ADX has to be above 20. That's the signal with the DMI. Now you have a good positive directional indicator well above the negative, good separation there. All that's good. The ADX has moved above the negative directional indicator. The sellers have just backed away. But one of the rules that we follow for the DMI as a confirming indicator to Elliott Wave is that ADX has to break above 20. So it's not there. If it does, may come back and relook at this. So for me, this is a no-go right now. Going back to our website, I thought I would just go ahead and share with you one of the alerts that we've just sent out today. So something to consider. It's in the speculative portfolio. So this is one that doesn't follow all the rules. And I just don't know tonight in front of the Fed meeting if we can, put something out. Even a strangle, the volatility could be crazy. Maybe looking at a strangle makes sense. But by the timing, who knows what's going to happen tomorrow before it goes on. There's a lot of hard to understand things. So this is one on rig. So it doesn't follow all the guidelines. It does have a really nice Elliott Wave pattern. So I wanted to show you that. But it is speculative because it doesn't have all of our confirming indicators in line. So what I like about this, they just reported earnings and the rig count has gone up. It looks great moving forward. And then you can see what's happened on the earnings report. It's coming down. And so it's had a big move to the downside. It's nearing a very strong level of potential support here. And it's in a really well qualified 5-wave to the upside pattern. We're at a 43% correction. We could come all the way down here to $5, which would be about the 50% correction, and also happens to be where support lies. So this is more of a longer term type of a position. And when we take a look at you can see that we sent out November calls. So it's longer term. We're not going to worry about some intraday things. If it broke 5, all bets are off. That changes everything, in my opinion. But as long as it holds above 5 and the earnings weren't bad, in fact, the behind the scenes fundamentals, I think it went down today because of the market, not necessarily itself. It does have a little bit of support that is trying to hold right here at 5.5. You can see it traded below it, but closed back above it. And so yeah, I think this, it's speculative and it should be considered that way. But I just don't really feel that there's anything else that we'd be comfortable with such a who knows kind of day coming up tomorrow. So I'm going to make a note of that one. And again, considered speculative. It doesn't have the results of all the indicators in the searches. And by the way, if you're wondering what this program is, it's called Profit Source. And you come back and look over here where I was looking at the search results. You can see these that say EWO. Those are mine. Those are my combinations of indicators supporting Elliott Wave. And if you are an EWO alert subscriber and you have the software, you get those. It's included in there. So you can see what I look at every single day in trying to figure out if it makes sense to send out a trade alert on any particular chart pattern. So again, this one, it doesn't go in one of the qualifying patterns. It's just a speculative position because of the reasons that I've given you. So there's not really much else to say on it. And as long as it stays above 5. So that's your stop. If it breaks below 5, everything changes. But for now, way long term, out to November, and we'll see what happens. It also has a pretty good descending triangle here. So perhaps we get some sort of a big breakout and it ends up being a really nice trade. I like the risk to reward on this one with the fact that it is a speculative trade. All right, spot on. Zach nailed it dead on. Let's go to some questions.
All righty, sounds great. Thank you for that very interesting presentation. As always, per usual, we have tons of great questions that are coming through, but with the limited time, we certainly won't get through all of them. So just please keep in mind that if we don't get to your question, it has nothing to do with the validity. We just only have so much time in this free session. So take that with encouragement to join the insiders meeting rather on Thursdays, which is for paid subscribers only, with a 45-minute Q&A portion. So obviously a much higher likelihood of getting your question addressed there if we don't get to it tonight. All right, let's dive right into it, Rob. We'll start out here with gold and oil.
I figured gold, so I didn't look at silver or gold because I figured that was coming. So I let those go. We actually have an alert on silver, which had a nice day today, as did gold. So I'm going to look at the SLV first, but I will bring up the GLD because that was the one that was asked about. And you can see it tried yesterday and then reversed and then back to the upside today. And so you have to like the price action there in a wave 3. And so the potential here, getting back above 23, I think was really important. It never really, you can see that it closed below it one day, barely 2283, and then no follow through day. So we got right back above it. That's been the key. We've been wanting to see it hold above that, and we'd give it 22 as well. So if we had broken all the way down to 22, we would added to our calls on SLV because there's so much support there, but it hasn't. So it's back in business with that move to the upside today. Who knows what happens tomorrow? I had mentioned that I really like GLD above 185. And we talked about this. This was actually asked about in last Friday's live market update as well. By the way, the live market updates are on the Hub Financial channel. So go to YouTube, go to the Hub Financial channel and register there. And you'll be notified as soon as we start the live updates on Friday. So taking a look here, you can see there's the wave 5 on GLD and closed at 187. And I've been saying I like 185, or excuse me, I like GLD above 185. It hadn't been able to do anything with it. But do you know what's coming next? Those of you that have been watching for a while, does one day mean anything? No, I mean, we're already in SLV. I wouldn't mind adding GLD, especially if the market gets squirrely, but you have to have a follow through day. When you break above major point of support resistance, break out of a triangle, anything along those lines. One day doesn't mean anything. You have to have the follow through day. And you can see perfect examples of that right here. Broke above 185, no follow through day. Broke above it, no follow through day. Gapped up, no follow through day. So that tells you it matters tomorrow. Now, depending on what the Fed does, if we get a higher close on GLD tomorrow, and SLV will probably come along with it, I think this is a great space to be in. I'd be bullish on both metals if we can survive tomorrow. So we have to have the confirmation day tomorrow, but I figured that was going to be asked. I'm glad it was, because that's been my commentary. I like gold above or GLD above 185. Well, we're there today. Can we follow through tomorrow? That's going to be key. I'm sorry, Zach, what was the other symbol? I forgot.
No worries. Let's just go to USO and then UNG.
Oh, oil, duh. How could I forget that? Okay, so taking a look at oil. And I'm going to close some of these. I've got 9,000 things, and I don't want to have a virtual memory problem here on my computer with all these windows open. Lots to talk about tonight. I got through it pretty quickly. So there's oil. We have a butterfly on oil. We had put a directional put butterfly on, expecting oil to come down, which it did. Came down to 65. We're still within the wings of the butterfly. And so now we're a little bit oversold, and we broke below 65. Do we come back up and test it? I feel like and then there's the separation. There's another one of my rules. People are calling these Robisms now, but they're just rules that I've watched for a while. No security in any time frame gets very far away from the 10-day moving average. So that's pretty far away from the 10-day moving average. And you can look and see this is why it's a rule. Every time you start to move, whether it's above or below the 10-day moving average, what happens? You correct back to the 10-day moving average. If we bounce back up on oil, back up towards 65, with the fact that we already have the directional part from the move down to 65, that's going to be awesome for our butterfly. So we'll see how that plays out over the next couple of days, with the fact that it's currently a bit oversold. 60 needs to hold. So that's where our support is. If we hold at 60, if it doesn't bounce back up to 65 now, coming down to 60 would be okay. As long as it holds 60 and bounces from there, that's great too. So you can see we're in a pretty good spot with our directional put butterfly on USO. We just don't want it to break 60. That would change everything. So we're oversold right now. 65 clearly support resistance. You can see the line there. And you know, I think the question is, does it bounce back to 65 and test that first, or do we need to come down to 60 before we attempt to bounce back? I think it's highly likely that we're going to test that level. You can see what happened last time we broke it in March. Not only did we go back and test 65, we broke above it and went up and tested 70. So do we do that again? Oil's interesting right here, but for right now, it's a touch oversold, and it does seem that some sort of test of 65 is in the cards. Does it have to go lower first is the only question before it turns and tests that. And then how it acts at 65 will determine where we go from there. All right, next question. I'm trying not to be so long-winded.
No worries. Let's head into UNG.
Yeah, you know, we had a long discussion about this on Thursday night, and the fact that it's just been churning in this low range, it seems like there's a way to take advantage of this. But we actually looked at the options on Thursday night. We do an extended Q&A Thursday night for our alert subscribers, and we have limited time tonight, but we try to get every single question in with a 45+ minute Q&A on Thursday nights. And we actually looked at the options to see if there wasn't something range bound that we could do, but it's been range bound and tiny intraday volatility that the premium's just been sucked out of the options, that there's really nothing that you could put on that made any sense. Now, there is a possibility if we don't hold here, but you can see what I'm talking about because we've held here the last couple of times. My mentor used to say, third time's a charm. That was one of his rules, that when you test a support or resistance on the third time, how it acts, it's likely the directional move from there. So in other words, if we hold here and bounce, the likelihood would be we continue the bounce to the upside. If we break this level, the likelihood is we continue lower. That was one of his rules that he taught me. So, we need to see what happens right here, right where we are. 650, that's the line in the sand, literally, on UNG. And we couldn't really construct anything sideways to take advantage of this. You have to wait for a directional move. We'll have that. If we break below 650, then we're probably coming down to 5. And that could be a nice trade down. If we hold here and bounce, of course, you would have some resistance, right away here at 7. But if we could break above 7, then we could potentially head back towards 9 or 10. But what happens in the next day or two here with UNG is going to determine. But just to summarize again, if it breaks 650, I think you have a downside trade. If it holds and bounces, probably have an upside trade. But I always do this, dual commentary that if you're aggressive, if it bounces from here, you can go long. If you're conservative, let it get above 7 and then go long, because that would be a break above 7, and most certainly there's more upside to go. So that would be my view there. But interesting that one was brought up.
Absolutely. Yeah, it's always interesting to look at that chart, especially as the past few months. So
yeah, it's been bizarro land for natural gas.
Absolutely. So we got about 5 minutes left and about 500 questions remaining. Through as many as we can. We will go over to SoFi.
Okay, we looked at that one in the past. So I think I actually made a comment that we wanted to see that one, to take a look again and see what happened with it. And well, there you go. There's what happened. So big move to the downside, and yikes. Let me get this off because it's to make the earnings dates off there. But you take a look here, and that was a pretty ugly move. Earnings, yeah, obviously not favorable. So can we hold here at 5? And I do believe that there are a lot of institutions in this. My opinion would be they'll do something similar to what happened in December and come in and support it. That's what happened. This is a really good example. Good choice, Zach, because we broke below here, and there's a limited amount of time that even institutions like mutual funds, et cetera, that have an aggressive objective as their investment objective, aggressive growth, they're the only ones that can own single digit stocks. So if it breaks below 10, it's aggressive growth institutions only. Well, it starts to break below 5, then they're going to have to get out too. So they tend to come in and support it. And what they're trying to do is create a short covering rally. So they support it. And you can see they were successful here into January and February. We came back down and tested it. So no harm, no foul there. Started to move back to the upside, but now we're back down here again. Will they come in and support it again? Vertical moves lower. I don't like vertical moves in either direction because they often get retraced. We are oversold. I think here's another really speculative one. If you wanted to step in and try to look for something very speculative, you could look to see. I wanted to pull volume up. That was a lot of volume. That's institutions bailing rather than supporting. See what happened here with the short covering that bursted it up there. And so notice when it broke below here before, you didn't have that. So this is really speculative because some institutions have thrown in the towel on this one now. They're not hanging around and waiting. But it's oversold right now. It's at an area where if it's going to hold, it's going to hold right here. And it's pretty below the 10-day moving average. You could get some sort of a short-term bounce here. 2 things, perhaps bounce off, 3, bounce off support at 5, come up and fill this gap, and then come back and test the 10-day moving average. So there are a few things working if you wanted. I think this would be a really short-term speculative trade. It would just be a short-term trade on some sort of bounce here. Before you ever consider going longer-term long on this, I think you would want to see it back above 6. And who knows if that even happens. But yeah, well, we had talked about that one before, and you can see the Elliott Wave pattern. Look, there's that 61.8% wave 4. Isn't that amazing? I mean, how good has Elliott Wave Fibonacci been on the stuff we've looked at tonight? And, you guys are asking for these. This isn't me presetting anything. And I don't do that on Tuesday nights with TradeFinder. I don't look at the search results ahead of time, because I like to look at them with you all so that we can do the talking points out loud. All right, I'll shut up. Another one, Zach.
I was going to say, I've said it before and I'll say it again. We have a very informed and knowledgeable subscriber base. So it's always great to see those questions come through. All right, I'll pass through as rapid fires, quick as I can, as many questions as I can. Interesting one here from Peter. It says, could we look at the French market? I believe that has performed well. And I think that's FR40, but I'm not sure that that's in our system.
The French market is going to be
The
an
index, at least.
It's going to be an EW symbol. What French be?
Maybe we do some research and come back to that one.
Let me see.
Follow up.
CAC Caron. So it can't be EWC for CAC Caron because that's Germany.
Yeah, let's write that one down and we'll
and EWK is Belgium, so that's not. Yeah, sorry about that.
Either in the market update or next TradeFinder.
Yeah, I'll make a note of that and I'll do it in the update.
Next up, we'll go to Angel. Hey, Rob, welcome back. Can you compare HYG, i.e. smart money, looking at its ADX and discern what its implications are on the market? Thank you.
Yeah, this is going to be a wild one tomorrow too. And look at that pattern. So this is high yield bonds for those of you not familiar with. Look at this. So here's some more Elliott Wave stuff. That wave 4 went to 81%. That's disqualified. So you turn the Elliott Wave off when you see that. And then you would have turned it off anyway because it's clearly in a big triangle pattern. And again, reading the works of Elliott, and you got to go behind the scenes of just the rules that you see on the internet. Read the stuff the man wrote. I mean, he spent decades basically perfecting this system, and he learned a lot about his own system. So I think it's important you read his notes basically. And he would always say that a triangle trumps everything. So even if that wasn't a disqualified pattern, my long-winded point is you would have turned it off anyway. And you have the three major moving averages that I watched, the 10, 30, and 50, all converging at the point of this triangle. So it looks to me like something's going to happen very soon out of the HYG. And maybe it's still hard to imagine it won't be tomorrow. But I like, as Angel probably knows, because he asked about the ADX, I prefer when the ADX gets below 15. It's not quite there yet. We're around, what, 16? We're getting close to 16. So I would have preferred to look at possibly putting a triangle or something on this. I would have preferred if the ADX was below 15. And I think that's what would have happened if tomorrow wasn't Fed day. But with that, who knows what happens? Bonds are probably going to be crazy. The market's probably going to be crazy. So does this launch us to break out of this? It may very well. I just wish that ADX would have been lower, and I think it would have been a fantastic strangle, especially with the Fed meeting acting as a catalyst to move the stock. So yeah, a couple more real quick.
Okay, you got time for two more?
Two more.
Do it. So we will go with, well, one that's been in high demand is going to be FSLR.
Gosh, I mean, I was saving yours, Zach. Is that going to be the last one?
Nobody's helped me out this evening with that.
Because it's really important. So I'm going to look at it anyway.
Oh, okay. By me, no arguments there.
My dyslexic fingers there finally got the symbol up for solar, and breaking 200 was key, which it did on earnings, and a little surprising. So we're below the 10-day moving average. We've gapped down. 180 has some support there, which it's trying to hold. The problem here is the stronger support is all the way down at 160. Does it make it down there? I think this is no man's land to me. Maybe you get some sort of a real quick bounce back towards the 10-day moving average. I don't know that it's going to try to fill the gap right now. If you could somehow get it to 160, I think that's a great point to go long if it makes it down to 160. It may not. It may hold right in here. I guess you just got to watch this one for a couple days. But if there was any way First Solar could make it down to 160, then yeah, that's a golden entry to me. And this one feels a little more in no man's land, as I said, because of the gap down, a little bit of support here, but not as much at once as there is at 160. Maybe it gets a quick short-term bounce because it's so oversold right now. Yeah, that's there. I'm going to go ahead and pull up NVIDIA for you, Zach, as my welcome back to Florida. And the reason that I wanted to say that is we've been talking about it. Everybody's been asking about it for so long, and it's been the same story. The Led Zeppelin song remains the same is what I've been using as the analogy here because of 260, 280. And if we broke below 260, I felt like you go short. If it broke above 280, I think you can look long. Well, look what happened. It broke above 280 yesterday in a big way. So I was really watching this today and had an itchy finger, would have loved to have been able to do something with this today. As you see, we're still in the wave 3 and then no follow through. But are we just coming back down to test 280? The earnings report, as you can see, is on the horizon there. The 24th is the earnings report. So do you get in front of it before earnings? It looked like maybe you could get a run into earnings was what I was thinking, but we didn't follow through. But you could also make the argument, okay, well, it finally broke above 280. It just is coming down to test that breakout point. And that's a fair assumption as well. But can it hold 280 and bounce tomorrow? So it's going to be interesting there. But I wanted to show that one because it's been asked about so long and there's been nothing to say because it stayed in that trading range for so long. All right, what was the last one you had? We're way over. We got to hurry.
Yeah, no worries. Let's go with LEN for the last one. And to anyone else that we did not get your question, please, again, no, it has nothing to do with the validity. We just only have so much time. And certainly take that as encouragement to attend the insiders meeting where Rob and Jeff get through almost every question every time. So thank you for joining us for this live session. And I'll pass back over to Rob to wrap things up.
Yeah, Lennar, home builder. I've been so wrong on this. This is a sector that I have just wash my hands of. It makes no sense to me. I don't get it. But it's held in there so long. At some point, I think this housing thing is going to bust. I mean, I'm not calling it a bubble, but it's been stubbornly strong, stronger than I thought it would be as the economy is weakening a bit. The consumer's tightening their belt. Interest rates have gone up, and yet it's just continued to consolidate and move forward. This is a pretty good example. And, you know, it came down and tested 110. It broke above it. It tested it perfectly. That's what I was wondering. Is this what NVIDIA is going to do, where it came down and is testing 280 and then move back to the upside? You can't argue with what this chart looks like. And so, yeah, there's earnings out there, but there's plenty of time to make a trade. As long as it can stay above 110, I think you can go long and look for a further extension. We're at 144% already. That's why I'm saying I don't get it. I don't know how it continues to go to the upside, this sector. But if it's going to go to the next fib level, that's 161.8%. That's enough of a trade. So I feel like my throat lozenge is gone and there comes the cough. So it's telling me we're way past time. So it's held the 10-day moving average on the low is above 110. As long as it stays above 110, I think you can go long there. But 110 is the stop. That's a hard stop in my opinion. And if you wanted to go long, perhaps you get a run into earnings. All right, we'll leave it at that. Thanks, everybody. I'm sorry for running long, but I think we had a wonderful session tonight. I appreciate your time very much, sincere about that. And hopefully you found tonight informative and educational. And have a great rest of your week. Tomorrow is going to be really interesting.